$74.6 billion. That's how much the Federal Reserve injected into the banking system on December 31st, 2025, through its Standing Repo Facility, the largest single-day emergency lending operation in American history. Not during 2008, not during March 2020, on New Year's Eve 2025, while Americans were preparing for fireworks. The official explanation? Routine year-end liquidity management, technical adjustments, nothing to see here. But here's what they didn't mention. This injection shattered the previous record of $50.35 billion, set just 2 months earlier. Banks borrowed this emergency cash using $31.5 billion in treasury bonds and $43.1 billion in mortgage-backed securities as collateral. Someone needed $74 billion overnight, badly enough to pledge their most liquid assets. 6 days earlier, on December the 26th, the New York Federal Reserve executed a $17 billion emergency injection to an unnamed institution. The identity, classified, under disclosure rules until 2027. On November 14th, the Fed had quietly removed daily borrowing limits on its Standing Repo Facility. Unlimited capacity. Any eligible institution could borrow as much as needed, with no questions asked. Connect these 3 events. Unlimited borrowing enabled November 14th. Secret $17 billion December 26th. Record $74.6 billion December 31st. This isn't routine housekeeping. This is a pattern. While the Fed pumped emergency liquidity into banks, something unprecedented unfolded in silver markets. On December 30th, silver touched $90 per ounce in Asian trading. By January 2nd, it retreated to the low 80s after the CME Group raised margin requirements twice in 48 hours. But the retreat wasn't driven by fundamentals. It was exchange intervention to prevent complete market breakdown. The divergence between paper and physical silver reached levels never seen in modern commodity markets. In Tokyo, physical silver coins traded at $130 per ounce. In Dubai, 1-ounce coins sold for $99.93 on January 2nd. Meanwhile, COMEX March 2026 futures closed at $72.26, an 80% premium for physical metal over paper contracts. This isn't normal market behavior. This is bifurcation, a complete split between actual silver you can hold and contracts promising future delivery. For the first time in decades, paper and physical markets have decoupled entirely. Between December 1st and 4th, over 47.6 million ounces of silver were claimed for delivery from COMEX vaults. That's more than 60% of COMEX's total registered inventory in just 4 trading days. Registered inventory is silver available for immediate delivery against futures contracts, the metal that backs the entire paper trading system. COMEX total silver inventory has collapsed 70% since 2020. In 2020, vaults held over 1.4 billion ounces. By January 2026, that number fell below 450 million ounces. The registered inventory, the metal that actually matters for settlement, has been draining even faster. Every month, more silver leaves COMEX vaults than enters. Industrial users take delivery instead of rolling contracts. Investment funds convert paper to physical. And now, with China's export restrictions active, the replacement flow from the world's largest refining center has been cut off. China implemented new export controls exactly as scheduled on January 1st, 2026. Only 44 companies received approval to export silver during 2026 to 2027. These companies must meet stringent requirements, including annual production capacity of at least 80 tons and credit lines around $30 million. Small exporters are completely shut out. China controls between 60 and 70% of global refined silver supply. Not mining, but refining capacity. Most silver comes from the ground as a byproduct of copper, lead, and zinc mining. That ore must be refined. China dominates that infrastructure. When Chinese exports get restricted, global availability contracts immediately. The timing aligns with broader geopolitical strategy. In late 2025, China exported record volumes, over 660 tons in October alone. These shipments went to London and New York vaults, temporarily relieving Western inventory pressures. But they also represented front-running. Chinese exporters rushed to fulfill contracts before the January 1st deadline. Now that door is closed. Western industrial users face a stark choice: pay massive premiums to buy from Shanghai, where physical silver trades above $80, or scramble for alternative supply chains that don't exist at scale. Latin American mines could potentially increase output, but that's a multi-year timeline. New mines take over a decade to develop. There's no quick fix. Industrial demand is relentless. Silver isn't optional in high-efficiency solar cells, semiconductors, or electric vehicle electronics. When you're manufacturing hundreds of millions of solar panels or billions of smartphone components, even small efficiency losses multiply into enormous competitive disadvantages. Industries that depend on silver don't reduce consumption when prices rise. They pay whatever is necessary. The math is brutal. Global silver demand in 2025 reached approximately 1.24 billion ounces. Total supply came in around 1.01 billion ounces, a deficit of over 200 million ounces, the fifth consecutive year of structural shortage. Every year since 2021, the world consumed more silver than it produced. Those deficits get covered by drawing down above-ground inventories. But inventories aren't infinite. COMEX registered silver dropped 70% since 2020. London vaults lost approximately 40% over the same period. Shanghai inventories fell below 446 tons, the lowest since 2016. At current consumption rates, some estimates suggest 30 to 45 days of accessible reserves remain before physical delivery becomes impossible at any price. That's when paper contracts become worthless. If COMEX vaults don't have metal to deliver, what do you own? A legal claim to something that doesn't exist. The exchange can force cash settlement, but if you're a manufacturer needing actual silver for production lines, cash doesn't solve your problem. You still need physical metal, competing in a spot market where prices have completely disconnected from futures quotes. The spread between exchange for physical mechanisms blew out to 78 cents per ounce for May contracts. Under normal conditions, this spread stays within pennies. When it explodes to nearly $1, it signals severe dislocation. Traders are paying massive premiums to extract actual metal because they do not trust futures markets to deliver when contracts expire. Then came coordinated margin hikes. December 27th, CME raised silver margins. December 29th, they raised them again. Silver touched $90 on December 30th. After the second hike, prices fell to the low 80s within hours. Shanghai also raised margins to 20%. Coordinated exchange intervention across markets, designed to cool a rally threatening to spiral into delivery crisis. The real story emerged in bank positioning data. In early January 2026, analysts noticed unusual patterns in COMEX delivery reports. JPMorgan Chase appeared repeatedly on the stop side, standing for maximum physical delivery Over 1,000 contracts in a single day. Each contract represents 5,000 ounces. JPMorgan extracted millions of ounces from COMEX vaults into private storage. The same bank that paid $920 million in fines for manipulating precious metals markets in 2020, the positioning reversal was even more dramatic. Between June and October 2025, JPMorgan completely unwound a 200 million ounce short position in paper silver contracts. For years, the bank maintained this massive short, creating downward pressure through derivatives. By October, that short position was eliminated entirely. JPMorgan didn't just exit shorts. The bank flipped long, accumulating over 750 million ounces of physical silver, valued at over $40 billion. Nearly a full year's worth of global mine production. No single institution in modern history has controlled such a concentrated position in any major commodity market. JPMorgan now controls approximately 40% of COMEX silver futures contracts. This is not normal behavior. When a major bank that spent years shorting silver suddenly flips to maximum long positioning and extracts physical metal from exchanges, it signals fundamental reassessment. JPMorgan's traders have access to order flow data and market intelligence retail investors never see. If they're abandoning shorts and accumulating physical at scale, they're seeing something in supply-demand balance that justifies radical action. The options market confirms this. The 25 delta risk reversals skew for May. Contracts hit 3.0, among the most bullish configurations seen all year. Traders are paying substantial premiums for calls relative to puts, indicating expectations of significant upside movement. Institutions aren't just positioned for higher prices. They're willing to pay for upside exposure while maintaining limited downside risk around $32. Deutsche Bank appeared on delivery reports issuing silver. Citigroup took significant delivery. The pattern across major banks points to coordinated recognition that paper markets are becoming unreliable for actual delivery. Institutions convert futures to physical before the system breaks. The feedback loop accelerates. As physical premiums widen and delivery becomes uncertain, more institutions convert paper to metal. As metal leaves vaults, inventory drops further, widening premiums. Each step reinforces the next. At some point, the futures market loses its function entirely. COMEX prices become irrelevant if they don't reflect actual acquisition costs. Shanghai is already there. Physical trades above $80, while COMEX futures remain in the 30s. The 12% premium gap isn't arbitrage because you can't move silver freely anymore. China's export controls work both ways. The global silver market has fragmented into separate regional markets with different price discovery. This mirrors what happened with rare earth elements in the early 2010s after China restricted exports. Prices outside China soared, while domestic prices stayed lower. Western manufacturers faced squeezes and paid massive premiums. Alternative supply chains eventually developed, but it took years. Silver is following the same playbook with higher stakes because applications are broader and less substitutable. The Fed's $74.6 billion injection starts making sense in this context. If major banks face liquidity pressures from margin calls on commodity positions or need emergency funding for delivery obligations, that explains why someone needed that much cash immediately. The $17 billion to an unnamed institution on December 26th could have been an initial stabilization attempt that later required the larger operation. The Standing Repo Facility had been dormant for months before December. Then suddenly, $17 billion December 26th, and $74.6 billion December 31st. After January 1st, it dropped back to zero. Whatever emergency required that cash was acute, time-sensitive, and resolved once liquidity was provided. That profile matches a margin call or delivery crisis more than routine year-end management. The paper-to-physical ratio tells the story. 356 paper contracts exist for every physical ounce backing them, an inverted pyramid balanced on a shrinking base. It works as long as most holders accept cash settlement instead of demanding delivery. But that preference is shifting. The December delivery surge, physical premiums in Tokyo and Dubai, Shanghai price divergence, JPMorgan's positioning reversal, China's export restrictions, Fed emergency injections. These aren't separate events. They're symptoms of the same condition. The paper silver market is breaking down because it's lost confidence that contracts can be reliably converted to physical metal. Once confidence erodes past a critical threshold, the system can't be repaired through conventional means. Raising margins doesn't create supply. Fed lending doesn't refill vaults. Exchange interventions might suppress paper prices temporarily, but they widen the gap with physical premiums, accelerating the divergence they're meant to control. JPMorgan's 750 million-ounce position is larger than anything the Hunt brothers accumulated in 1980, but it's held as physical metal, not leveraged futures. The bank paid outright, storing it in vaults under its control. No margin call risk, no forced liquidation mechanism. The bank has moved its precious metals team to Singapore, positioning for Asian industrial demand and proximity to Shanghai, where physical premiums are highest. This isn't a short-term trade. It's a multi-year strategic position based on conviction that silver supply will remain structurally constrained while industrial demand grows. JPMorgan wouldn't commit $40 billion unless senior management believed fundamentals justified it with high confidence. The year 2026 is shaping up as a defining moment. Gold gained over 60% in 2025, silver more than doubled. Central banks are buying gold at record pace, exceeding 1,000 tons annually for 3 straight years. De-dollarization trends continue as countries reduce treasury holdings and increase hard asset reserves. The entire commodity complex is repricing based on recognition that supply chains face persistent constraints. Silver sits at the center of these converging trends. It's both industrial and monetary metal, essential for green technology and military applications. Produced primarily as byproduct, so supply doesn't respond quickly to price signals. And now the dominant refining center restricted exports, while largest bullion banks extract physical from exchanges. The pattern is clear. The signal is undeniable. What we're witnessing isn't a normal commodity rally or speculative bubble. It's the early stage of a supply crisis that will reshape global industrial production and financial markets. The Fed's $74.6 billion wasn't just about year-end liquidity. It was about preventing a cascade that could expose how fragile the entire system has become. The story isn't over. The next chapters will be written in delivery reports and vault inventories, in decisions of industrial managers securing supply chains, in policy choices of governments facing resource constraints. The trajectory is set. The silver market broke in December 2025. What comes next is managing consequences, not preventing it. Watch the data. Watch the vault inventories. Watch the physical premiums. The story is there, written in numbers that don't lie.